Well, everyone, thanks for joining today, and thanks for being with us for the past month of the Ag Policy webinar series. I think this has been a really informative time, and I think I appreciate hearing what my colleagues in the farm management team are working on and thinking about, and I hope it's been informative for everyone who's joined as well. We kind of started with this policy series with the intention that a lot has changed in the ag policy landscape this last year. There's a lot of things to sort through, and that's been indicative in real time, right? This morning, many of you may have seen that President Trump, along with USDA Secretary Brooke Rollins, announced that there will be an additional $12 million paid out to farmers for what's called basically a bridge payment while one big beautiful bill payments kind of come up to speed, but to pay farmers basically for trade compensations, trade damages that they incurred from lost prices, particularly from China, right? So we didn't intend it to be this way, but policy changes in real time, and there are things to talk about kind of on a continual basis when it comes to agricultural policy. And we didn't know that when we started this policy series 4 weeks ago. So today we're going to have a conversation, kind of a two-part conversation that I will lead. First on changes to conservation policy that happened this last year, and also just kind of gaining an understanding of conservation policy within U.S. agriculture. But then to kind of wrap up this series and kind of dovetail going into the new year, thinking about and asking questions about what does farm policy look like moving forward. So with all of these changes, what should we be on the lookout going into 2026? And how do we anticipate kind of the landscape of agricultural policy change moving forward? So, like I said, this will be kind of a two-part conversation. One, today I want to spend a little bit of time just kind of reviewing what the structure of USDA conservation programs are in general in the United States today, but then understand too how those things have changed underneath the One Big Beautiful Bill Act, particularly to the conservation title. Then we'll transition a little bit and just talk about a just sort of general discussion of trends in agricultural policy making as we move forward. But first, I want to sort of pause and also say, we have two polls as we have had every time of our meeting together. So I'll ask Silva to kind of launch that first poll, just gain kind of a demographic understanding of who's joining us today. And then we'll circle back at the end with a second poll that asks about this topic in particular today. Okay, so please take a few moments to fill out that poll. Okay, so in general, there are two types of programs that we talk about when we think about conservation policy in the United States. One, particularly, that are land retirement programs that we take agricultural production out of production in general, and farmers receive payments for taking that land out of production and thinking about it as kind of a rental payment for taking that land out of production. The second and increasingly more popular types of programs are working lands programs underneath the Environmental Quality Incentives Program and the Conservation Stewardship Program. Okay, but all of these programs are around 1.8 billion for the Conservation Reserve Program. The Environmental Quality Incentives Program is about a $2 billion annual allotment from the federal government. And the Conservation Stewardship Program is about 1.1 billion annually. I'll briefly say here for the Working Lands Program is that the Environmental Quality Incentives Program is targeted towards new adopters. So farmers who are considering or thinking about adopting conservation practices for the first time, whereas the Conservation Stewardship Program is in place to basically reward good stewards of the land or who have been stewards of the land so far. And so those two programs, though they are kind of similar in the types of practices that they do target somewhat different audiences. And when we talk about the Environmental Quality Incentives Program, a lot of what we're talking about are practices that farmers can add on to operations. It's not a drastic change of what they are already doing in row crops that they're growing, but As we can see here, so this figure takes USDA data and plots the top 10 practices that are funded from the Environmental and Quality Incentives Program as a percentage of those top 10 practices, right? And so what we can see is honestly, there's a lot of attention and a lot of that funding is devoted to cover crop adoption. If you're in the conservation agriculture space, this is probably not that surprising to you. We as extension professionals in our crops and soils division within UW Extension talk a lot about cover crops. We have a lot of research that happens as it relates to cover crops here in agriculture in Wisconsin. If you're a part of producer-led watershed programs, which are our state programs here in the state, you know, a lot of attention is given to cover crops. And the similar story is true from sort of a federal perspective on the practices that they go in the ground. So other practices, you know, that you can see are residue and tillage management, or no-till is the pink, is a pretty big slice of that pie. Other practices are, you know, including fixed cost investments, including like stream bank stabilization or infrastructure investments um, on our farmland to sort of decrease runoff that goes into our waters, right? So in general, this is what we're talking about when we talk about the Environmental and Quality Incentives Program. My mind always goes to cover crops when we think about investment in from these programs. When we look at what this looks like in Wisconsin in particular, the Environmental and Quality Incentives Program has sort of increased the dollars that have been paid out to farmers across the state through EQIP. Around 30 million a year goes to Wisconsin farmers, but we've seen sort of a decrease in the amount paid through the Conservation Stewardship Program. And this is a pretty general trend that has happened nationally as well. The Conservation Stewardship Program in the 2018 Farm Bill went from being a land-based practice or land-based program to a practice-based program. And so instead of farmers being paid for land that they had that was enrolled in the Conservation Stewardship Program, they got paid for practices that they had through the Conservation Stewardship Program in general, right? So there's a little bit stricter requirements on um, what it meant to be paid through CSP. Okay, so keep that $30 million in mind. We'll come back to that in a little bit. When we look at where in Wisconsin receives the most funding, we see a lot of EQIP funding going to our counties around the Green Bay, and including Brown County itself has the highest amount of dollars invested in the state. But so the big problem from an economic perspective when I think about these programs is that we are always limited by the cap that is on these programs from a federal level. Okay, so this chart displays the percentage of EQIP contracts that go unfunded every year throughout the US, right? Okay, so that this implies that there are 60 to 70% of farmers, if we look in the past decade or so, that want to implement conservation practices and they want to be compensated for them. But because of the federal limits that are on the EQIP program in general, only about 30 or 40% of those farmers actually get paid to implement these practices. Right, and we think back about what was the practices that are in that pie chart. These are practices that are expensive to implement, right? If they are variable costs like cover crops, you know, we're not only paying for the seed, but we're also paying for the additional management time, the termination costs, and the potential risks that they pose to our cash crops following that, right? For some of those fixed cost investments, right, these are not things that we undertake as farmers until we have that cash on hand, right? And so we really rely on these cost share programs from EQIP and CSP to actually be able to implement them. Okay, so when we think about these conservation programs from a national perspective, my perspective and my view on this as an economist is that we're never going to reach maybe a place where conservation is rolled out on every piece of land in the US, unless we see a drastic increase in the amount that's supplied through these programs, right? And that money has to come from somewhere, and ultimately it comes from taxpayers, right? So when we think about these federal conservation programs in general, this has been true over the last decade, is that there's demand from a farmer perspective to implement these practices. The supply of funding has just been limited, right? And it's kind of somewhat of a lottery to determine who gets funded and who doesn't get funded, right? So from a farmer perspective, if you're considering implementing these practices like we want farmers to do from a conservation perspective, we're asking them to take on a lot of risk, right? When there's a reality that they may not actually be paid through EQIP to fund that, right? So acknowledging that this issue existed over the last 10 years, that we need more funding for these practices to be rolled out on the landscape, we want to think about what the Inflation Reduction Act did, and this is under the Biden administration and the passage of the Inflation Reduction Act. There was almost a doubling of the amount of funding that was available through EQIP to be paid through these farmers, right? So this figure is from the Congressional Research Service. The yellow here plots what existed under the Farm Bill, under the 2018 Farm Bill for these conservation practices. Close to $5 billion annually, and that's about what we added up from the Conservation Reserve Program, from the EQIP program, and from CSP, and we get close to that $5 billion amount. Well, the Inflation Reduction Act set out funding or outlaid funding that, like I said, was going to increase this almost twofold for these programs, right? So we were seeing an increase by 2028 up to about $9 billion that was going to be paid through farmers from the Inflation Reduction Act. And that's to say farmers were also receiving in 2024 and in 2025, a lot of farmers were already receiving Inflation Reduction Act funding, from this uptick here in this dark blue region. Okay. But the one big beautiful bill basically rescinded what was going to be available from the Inflation Reduction Act, or it rescinded the Inflation Reduction Act basically altogether. That's not to say that that money completely disappeared, but it reallocated how that money would appear over time. Okay. So the green area to the right of this 2025 bar was what was projected from the 2025 Congressional Budget Office baseline. We see that kind of as a continuation of that yellow region. But then this lighter green region that overlays this blue region, we can see that that was kind of that what reallocated from that Inflation Reduction Act funding, right? So there, that funding still exists, and it's bundled into the Farm Bill baseline now, but the years in which it is available changed. Okay, and again, we'll come back to that in a little bit. Okay, so what was the Inflation Reduction Act doing? And I kind of mentioned this, is that it increased funding for these programs, but it changed where that funding was coming from. Okay, so the program still existed as it did, but some of that funding that goes through EQIP was coming from Farm Bill allocated funding. Some of it was coming from Inflation Reduction Act funding. Okay, so this data from NRCS shows exactly this, that in 2024, farmers in Wisconsin, I'll go back a few slides here. This figure stops in 2023. Okay, so this was pre the Inflation Reduction Act being rolled out, and in 2023, farmers were receiving somewhere around between 25 and $30 million in Wisconsin. Okay. From the Inflation Reduction Act in 2024, the amount of funding that was paid to farmers through EQIP almost doubled, and that was because there was a doubling of this amount available from the Inflation Reduction Act, right? So there was a pretty drastic increase in 2024, or a pretty drastic availability of farmers to receive EQIP funding because of this Inflation Reduction Act, right? So this was really interesting. When the Inflation Reduction Act was passed, I knew that this figure sort of existed, that there was a demand for these conservation programs, and I was really interested to see how much there was kind of this question like, are there actually enough farmers to receive this funding? And this then shows, at least to some extent, farmers in Wisconsin were really leveraging those funds, taking advantage of that Inflation Reduction Act funding. Okay. The same held true with the conservation stewardship, but to somewhat of a lesser extent because it's a smaller program in general. Okay. So what does that mean then? Putting all of these kind of pieces together is, like I mentioned, with the passage of the One Big Beautiful Bill, there was sort of a reallocation of when funds would be available through these programs, right? So this just shows that basically that same information, but plotted just basically what's the net difference from what we expected in January 2025 to what we expect now under the One Big Beautiful Bill. So from 2025 to 2030, we expect a net decrease from what we expected prior to the passage of the One Big Beautiful Bill. But from 2031 to 2034, because the One Big Beautiful Bill outlaid spending for the next 10 years, that's when we expect to see that uptick of the conservation outlays within the agricultural title. Okay, so just putting this back together, right? So this figure showed the difference between the blue area and then this lighter green area are those net decreases that we expect through 2031. But then after 2031, those net increases are this region here to the right. Okay. So that's to say, we had a lot of momentum, I think, going, and that momentum was somewhat built into this Inflation Reduction Act. There was meant to be this scaling up over time, and somewhat of a rapid scaling up leading up to 2028. But now that we need to slow our roll in terms of expectations about how much actually may be available, because this is rolling out a little bit slower of a pace. Okay. The Conservation Reserve Program was not touched by the One Big Beautiful Bill. This was one of the major outlying programs that still needed to be addressed in this sort of skinny farm bill that was discussed after the passage of the One Big Beautiful Bill. There needs to be a reauthorization of the Conservation Reserve Program in order for new acres to be able to be enrolled in the Conservation Reserve Program. Okay. So generally in the United States, CRP Wisconsin is not necessarily a leader in CRP acreage. We see a lot of CRP acreage across the plains, but our farmers, especially in the southwest part of the state, are leveraging this to some extent, right? So there's still this question about what do we expect to change. And what do we expect maybe the caps to be in general? Well, so over time, the Conservation Reserve Program, we have seen a restriction of that cap from a federal perspective. So this yellow line plots what that cap is from a national perspective. And since 2010, we've seen that cap kind of come down. And that cap then gets sort of allocated across to the state perspective as well, right? So if we look at what Wisconsin CRP acreage is, that trend has largely been similar. Within Wisconsin, we saw some of the heydays of the CRP program. This plots it from 1986 to present day, where it's kind of really through that period of the 1990s to 2010s. But since the 2010s, we've seen a pretty large restriction of the Conservation Reserve Program. Now we only have about 200,000 acres statewide enrolled in CRP. Okay. And in general, when we think about if you're a farmer and you're considering enrollment in the Conservation Reserve Program, you may know that this operates in somewhat of a different way than our other programs as well. So the EQIP is sort of a fixed amount for those practices that you might get paid. Conservation Reserve Program, you submit basically a sealed bid auction for what you would be willing to enroll your land into CRP for 10 to 15 years on a continuous basis. And then USDA makes a decision on where that threshold basically is from that auction price, right? And so oftentimes these auction prices or what gets submitted from a county's perspective is pretty highly correlated with what we might expect county level rental rates to be and we can use some of our farm management tools to think about what those rental rates might be or what you might consider thinking about submitting for a bid in the Conservation Reserve Program. But again, in general, we expect these the average county level sort of CRP rental rates that are paid to farmers to be correlated with those rental rates more so in general, right? So we see some um, higher priced CRP payments on average at the county level, which is somewhat correlated with where our higher priced rental rates are in the state. And higher priced land is in the state as well. Okay, so somewhat switching gears now. We've had that conversation about conservation policy and kind of understanding what those changes are. As we've had this webinar series, I've kind of thought that maybe there was actually somewhat of a need to understand ag policy at somewhat of a more basic level to understand how the One Big Beautiful Bill was different from historical precedent. Okay. And so the last and kind of wrap up this conversation here to get our conversation here together today and then to kind of transition to discussion. I just want to have a general conversation about the Farm Bill in general and how One Big Beautiful Bill was different than the Farm Bill and how that maybe changes how we might expect going forward. Okay. So if you've been around agricultural policy in the agricultural policy world for a while, you know that the Farm Bill itself actually is only the farm is actually only a very small part of the Farm Bill, right? Nutrition programs make up about 75 or 76% of the Farm Bill. This includes things like SNAP or food stamps, as they may be formerly called. But these are all bundled underneath the Farm Bill, so to speak, right? And then the House Ag and Senate Ag committees facilitate how the funding of this program gets distributed across states and the administration of these programs, right? So when we think about Silva and Paul talked to us about ARC and PLC on the first of our webinar series 4 weeks ago. That's really only 7% of the total Farm Bill that gets debated and gets constructed supposed to be every 4 years. Conservation, which we talked about today, is only another 7% of that total agricultural package, and then crop insurance is something about 9%, right? So the rest of that 76% is actually devoted to basically the Supplemental Nutrition Assistance Program, or SNAP. Okay. Over time, sorry that this is a little bit blurry. Over time, this share of the nutrition assistance program has expanded, right? So in 2010, or prior to 2010, we saw about half of the Farm Bill actually devoted to these farm commodity programs and crop insurance and conservation. After that point, we saw bigger increases in sort of nutrition assistance, right? Some of this maybe, kind of came out of the Great Recession. There was a greater need for, food assistance during those times, and that nutrition assistance has basically persisted since then. Okay. Now, so to understand what the One Big Beautiful Bill was, there's some of this schoolhouse rock, how does a bill become a law kind of a thing that I needed to do myself. This was research that I needed to do. And so I suspect that some of us may not be familiar with this process as well, right? But so the reconciliation or budget reconciliation is a process by which multiple budget priorities or multiple committees within Congress and those priorities can be facilitated in basically to a single vote. So a mega bill that includes funding for agriculture, it includes funding for defense, it includes funding for healthcare, and so on, right? The difference between this budget reconciliation and our typical farm bill is that our farm bill is typically an omnibus bill that requires a 60% majority to pass in the Senate, right? And so that's meant, and that's why when we think back about our farm bill in general, why nutrition is such a big part of this, because in order for a bipartisan farm bill, where there's enough support to get 60% of the Senate to pass, is that there has to be priorities for more urban constituents, or constituents that are at least in non-agricultural counties, right? So that is why nutrition is such a big part of the farm bill, is that because in the compromise of that gets debated, the jockeying back and forth between what gets funded in a farm bill, some of those has to fulfill, sort of non-agricultural constituents as well, right, in order to be able to gain that bipartisan support. But in the reconciliation process, because Republicans now control the House, Senate, and the Executive Committee, this reconciliation bill could be passed with a simple majority, greater than 50% of the votes. Now, then the stipulation here is that the Byrd rule indicates that when reconciliation happens, the changes that the changes that are made within the policy ensure that the changes are purely budgetary, and that there's not new policy. This means that you can't introduce a new um, you can't introduce a new program within the Farm Bill, right? It's purely just a reallocation of funding that gets set for um, each of the committees, essentially, right? And so, for example, um, in this last round within the One Big Beautiful Bill, the House Ag they were given the House Ag Committee and the Senate Ag Committee were given somewhat separate targets, but in the end, the Ag title was given a target that they needed to reduce 120 billion dollars overall in terms of to reduce spending. That was the House that the budget committees came together and said, what each of the other committees needed to change their funding, and then it was on the House Ag Committee to come up with who gets funding, but still allocated within that 120 billion target, right? Okay. And so, as I mentioned, as it currently stands, because there was a Republican um, majority in the Senate, House, and in the Executive Committee, it allowed for there to be sort of a reprioritization within the Farm Bill title, or within the agricultural title, and what got prioritized, what got cut, and what saw increases, right? And that looked like is that commodities, and as we talked about 4 weeks ago, is that commodities saw a net increase. I think so this is just over the 2025 to 2029, but over that 10-year period, I think there was something like 66 billion additional outlaid for commodities. For like so raw this was our ARC and PLC programs, our crop insurance programs. Conservation, I think it falls underneath rural infrastructure here. So there's a net decrease in that conservation spending. But then the big sort of loser, or the big, where did this funding come from, was these nutrition programs. Okay. And so over the whole life cycle, I think over the 10 years projected outlays of this agricultural title, um, nutrition was set to lose us something like 180 billion, right? So recall we said that there was targets of about 120 billion for the Agriculture Committee to come up with someplace. More than 120 billion came from nutrition, okay? And that was then offset by changes to commodities programs, okay? The way that this looked, the way that these cuts looked for nutrition, was largely that there was additional requirements placed on states, so that states had to cover a larger share of the SNAP payments, if they failed to meet an error rate, essentially. Actually, at the end of the day, I think Wisconsin was one of the best states when it came to error rates, or missed payments, basically, that are paid to SNAP recipients. And so Wisconsin may be on the somewhat better end of this nutrition cut, but at a large scale, there was a lot of pushback and a lot of coverage in the media that this meant that households would receive significantly less that do rely on SNAP, right? And so in the end, in the One Big Beautiful Bill, there was, I think, kind of a mixed perspective from the agricultural community, there was pretty resounding support, and I think that we saw why that was. Way back to again Paul and Silva's conversation is that there was this additional 66 billion given to farmers. There was an update, raising those reference prices, raising that farm safety net. But there were also perspectives, particularly from Democratic constituents or Democratic districts, that this big beautiful bill cuts food stamps for millions and may cost the average household $145 per month, right? So that's to say, this reconciliation process creates, somewhat of a zero-sum game, or actually, in general, we have a net reductions from the budget reconciliation process. Some folks, viewed the One Big Beautiful Bill positively because of this, because of how it impacted agriculture. But there's real trade-offs and I think real undermining of the sort of bipartisan nature of what the Farm Bill typically is, right? Because there is this huge cut to nutrition. Okay, so just to kind of wrap up, I'm going to ask my colleagues to turn on their camera here in a second, but I just want to acknowledge that agricultural policy has somewhat changed over the last, how agricultural policy is formed and how agricultural policy is carried out has changed pretty drastically over the last 10 years as our policy system has become increasingly polarized as well, right? So the first is that we have seen increased precedent for ad hoc payments to farmers, right? So back to 2018 and 2019, we saw that in the market facilitation program, again, that was trade-related payments and trade-related damages that were paid to farmers from trade agreements or retaliatory tariffs that were in place in Trump's first administration, right? So $23 billion was paid to farmers after that 2018-2019 sort of trade dispute. We saw again early part of this year that $10 billion was paid out to farmers as sort of for economic recovery or to kind of cover some of those losses that were likely happening, and also acknowledging that we hadn't had a farm bill for an update to the farm bill for more than 5 years, right? And then today, as I mentioned this at the beginning of the call, I put question marks here, but it was somewhat confirmed in the news this morning that there's likely going to be another $12 billion paid out to farmers from trade-related damages this year, right? So this is becoming an increasing precedent as payments made directly to farmers, made on an ad hoc basis or kind of like afterwards. It's not built into the safety net to begin with, right? And the second piece of this is that bipartisan policymaking has become increasingly difficult, just as evident from the inability to pass a farm bill over since the 2018 year, right? So even after this One Big Beautiful Bill was passed, that right there was still these priorities that included things like the Conservation Reserve Program that still needed to be addressed. They still needed to be reauthorized, right? But because of some of that undermining that happened within the One Big Beautiful Bill discussion, right? Democrats expressed little interest coming to the table to negotiate a skinny farm bill after the One Big Beautiful Bill, right? So all of that led then to now a third extension of the 2018 Farm Bill that includes those skinny Farm Bill programs included in the continuing resolution to reopen the government, right? Okay, so our next deadline for ag policy as we move into 2026 is now this September 30th deadline to pass now a renewal of this 2018 Farm Bill, right? And so this has become a precedent as well, right? That we have been locked in this gridlock, have been unable to come to a resolution and negotiate and a compromise about what Farm Bill programs need to be updated, right? And then the last thing is that we also have the midterm elections in 2026 to look forward to, and that further complicates the prospects of whether or not either party will come to the table to negotiate on these terms, right? Now, all of this to say, I think we also have to acknowledge that agriculture is just one small part of the process of policymaking, and I don't envy policymakers that have to come to compromises on all of these things. And at the end of the day, especially with the fact that this is a skinny farm bill that needs to be constructed, right? This may end up being like a lower priority, and I think that's what's happened the last 3 years is that we've kicked the can down the road and other things have come to the top of the pile to negotiate in Washington, right? So I don't think that these things are necessarily controversial. That's why I call them facts. But what's I think less but what's less certain, I think, is how do these things affect farmers across the country, right? So with this increasing policy uncertainty, how do we think as economists? How do we think about how this complicates decisions? Well, one, as an extension specialist, it makes giving advice and it makes um, offering outlook to farmers and advice about decisions that they should make on farm increasingly difficult, right? So every year, Paul and Silva, make recommendations on what farmers should or should not invest in from opting into ARC and PLC. If those things are moving targets, right, it makes it hard for us as specialists to be able to give recommendations, and it makes decision making hard for farmers as well. From my perspective, I think a lot about conservation, right? Earlier this year, when there was sort of a funding freeze put on all of these programs, right, there was a lot of uncertainty whether or not farmers would actually even be paid for the practices that they had contracts for, that they already paid for and already put in place, right? And that adds risk to those decisions, right? And it undermines sort of at the end of the day what the programs are in place to do, which is to offer support for farmers. And so not only is there uncertainty from a market perspective, not only margins low, but if you aren't certain about what trade looks like going into 2026, or you aren't certain what these conservation programs look like going into 2026, it makes decision making increasingly difficult, right? The second thing is when I think about who is hurt by gridlock, right? When we think about what these extensions to the Farm Bill have made, what that's meant is that we have outdated policies and prices that were reflective of 2018 context, but not necessarily reflective of 2025 context, right? Um, if you joined last week, Andy Novakovic kind of referenced this as well, but these policies are in place to support farmers, not to dictate market outcomes, right? But if these policies and prices are not indicative of the current context, then it makes it them increasingly difficult to actually be able to support when farmers need support, right? And then, when it comes to actually being a recipient of a lot of those programs, whether it's the commodity support payments or from a nutrition perspective, we have households that rely on these payments for cash flow and for solvency, right? And when there's a government shutdown, as was the case, just recently, the folks who are hurt by that gridlock or hurt by the lack of those programs paying out what they're supposed to pay out, right, are that folks don't have that support when they need it, right? And then lastly, from a bigger picture perspective, I think a lot of experts are asking, will there ever be a traditional farm bill again, right? So what we saw with the One Big Beautiful Bill was somewhat of a decoupling or maybe an undermining of what traditionally has to take place, which is bipartisan policy compromise to make a farm bill exist, right? The One Big Beautiful Bill, because it lumps all of those things into one package, means that we don't have to go through that same process of allocating funds like we would in a normal farm bill cycle, right? And so, what does this mean longer term? I think it's folks are asking questions, will we ever see a traditional farm bill again, like we have seen for the past 100 years? in the U.S. And that means that we maybe see more volatility from administration to administration, more Congress to Congress, because there's this lack of sort of bipartisan effort to come together to provide new farm policy every 5 years, right? So that's kind of the doom and gloom. I don't mean to end on sort of a somber note. I think it's just a reality that what we are facing is that we as experts, even though we are here in Madison, we're not in DC, but we have less prediction about what will happen. We have less confidence that that these programs that are supposed to operate in one way will continue to operate in that way moving forward, and the processes by which we bring about ag policy, it's harder to make a prediction about what that is. However, I guess when I'll give one last plug for the Ag Outlook Forum, I think we're going to hear from perspectives on practitioners here in Wisconsin, especially within the sort of industry side of things, about ways in which industry has sought strategies to adapt and become resilient to particularly trade disruptions over this last year. And this is why we've not particularly talked about trade in these 4 weeks, because we'll save that discussion our conversation on January 27th. But in general, with increasing market uncertainty, I think there's also this need to build in adaptive resilience to our operations, relying on our own sort of ability to make cash flow whenever it may be harder to rely on those external sources of cash flow from the federal government, right? Okay, so I'm going to stop there, kind of open it up for discussion and questions. I'll ask my fellow panelists if they're on, that they can hop in and join this conversation as well. So, and just as one question that came up, just in general, is will this PowerPoint be made available along with the links to the data sources? Yes, so we will post the links to these questions, the links to this PowerPoint and a video of this PowerPoint. Afterwards, it may take a week or so for us to get it edited and to upload it to the website, but you can find this all of this information, including the past 6 weeks webinars, on that same page that you may have registered. So I'm going to kick this question then to my fellow panelists, Silva, Leonard, and Paul. As you think about how uncertainty in your areas of work, whether it's crops, dairy, crop insurance, how have you heard this impact farmers, and how do you think that this impacts farmers' decision making in general?
So I'll kind of kick that off, specifically from that dairy context. And as I always note, I'll often answer the question, but maybe not sufficiently. So if there is anything more, please do ask. But and I'm actually going to end it with a question that I think Jeff and Dr. Mitchell, I know that you've touched on before as well, that I think might be relevant to the audience here. So when we think about even just specifically the Farm Bill from this dairy context, the one big thing that I get asked a lot about is dairy margin coverage, right? What does that look like? What there's changes that came from one big beautiful bill. There's and with the lockdown or with the government shutting down, and not this, as you mentioned, not this standard process of having a farm bill. What does that mean? And when you take a look at the dairy margin coverage specifically, it's available for a range of sizes of operations. But if you're going to take a look at that first, traditionally tier 1 coverage, 5 million pounds, now 6 million pounds of annual production. Towards that, we'll say smaller end of the distribution of farms. So what I've been hearing and fielding a lot of questions on is that, right? When does enrollment happen? Is this going to continue? Do we need a farm bill in order to make this happen? And while there is a basket, if you will, of risk management tools out there in the dairy world, dairy margin coverage does kind of seem to underpin a lot of that and that decision making, right? So one thing that I've been thinking about or talking with people is, hey, I realized we didn't have a payment this year. Simply, a lot of that was just driven because our income over feed costs is dictated a lot by grain prices. Grain prices have been down, so even as milk prices softened, right, we didn't trigger payments. But as we take a look towards the next year, I think some of this political uncertainty also then kind of feeds into that of, hey, like, do I utilize this tool still? What does that look like, right? So that's what I've seen on that dairy side. It's just another factor that goes into this total portfolio of risk that people are trying to manage. So I think there's some of that. So on the dairy space, we'll talk on in that regard specific to the producers. I think, we've talked a lot on that nutrition spending already. Nutrition spending in the dairy industry is meaningful. We do see market clearing effects from that. So without those, there is an impact. The portion of this that I kind of want to end with a question on for you and Dr. Mitchell as well is uh, just kind of a natural function of commodity markets is consolidation, right? And as consolidation happens, so does the political landscape around that, right? And what does this look like from that policy perspective? And it also then brings up this question of effectiveness in the regard that it takes more funds in order to have that same impact on that farm level through these policy mechanisms. It doesn't mean that they're not important, things like this, but there is, a certain, let's call it efficiency factor that is derived there. And also kind of coming all the way back to that conservation question, if we have the effectiveness question, if we have the consolidation question, if we have this, do we have a traditional farm bill again in the future question? What does that kind of mean for the linkage of conservation programs to other policies, whether that's crop insurance, whether that's dairy margin coverage, whether that's what have you, right? What does this all kind of look at, drive towards? What are some of the indicators, factors, things like this? What should people be thinking about?
Maybe I'll put a pin in that question and I'll come back to it in just a second. But I guess I'll give, and Paul, do you have anything to respond to as it relates to um, these thoughts, these questions on the slide?
I've been thinking about it, and I think there's a short-term issue I worry about and a long-term issue. The short-term issue is it just makes it really hard for farmers to plan.
Yeah,
Like last week, you're trying to figure out how much fertilizer to buy, how many acres of corn to plant, how many acres of soybeans should I lock in some of my stuff, what should I be paying in rent? And all of a sudden, oh, here comes a $12 billion bill this week. Now, you might have had rumors of it last week, but you weren't sure what the details were. And the ad hoc nature of these and how they just suddenly appear or not, it just,
yeah,
I mean, we spent a lot of time last fall, winter, thinking about ARC PLC, kind of come up with that. And oh, guess what? We changed our mind this summer. You're going to get the best of both. We're changing all the rules for the 2025 crop year anyway. So all those plans you made are all different now. It just, I can't imagine I mean, they're not negative surprises or it's worse than it's just there's always extra money popping up. And I think
yeah,
when money pops up at random like this, it leads to inefficiency. You don't make good choices. You're not planning. You're all of a sudden like, well, now what do I do with it? And I've seen some of the ag extension folks on the ag econ side talking about how to think about what to do with this money, not just to throw it into the pile and have it. It could, it disappears more quickly unless you have a plan for it. And I think
right,
that's what makes this ad hoc nature of things. It just makes it very difficult to plan. And the other longer term issue, I'm just starting to get worried about what is the long term impact of these ad hoc payments we keep getting. The numbers you see are record numbers. I mean, this year, the 25 year is the second highest ever in terms of amount of money that poured out into farmers for payments during the pandemic. Because the other year was higher. It's the only year that's higher, and I I haven't. I'm starting to wonder because they keep happening, and so we need to start thinking about what is the effect of these. And it's just some of the stuff that Leonard touched on. I'm worried about how it's affecting the efficiency. It's delaying hard decisions that people need to make, investments in new ways of doing things. I feel like I'm worried we're falling behind in agriculture. I just see what's been going on in Brazilian soybean yields, Brazilian soybean acres. We're we are where they were 10 years ago in soybeans right now. And they're way ahead of us. And I'm worried about that's the one I know about. What's going on in these other crops and stuff. I just don't know. And I'm worried we're distracted by all these other things instead of thinking about the future, like maintaining our global competitive advantage in agriculture. Um, and all these ad hoc payments really worry me that we're getting distracted from thinking about the long run and thinking, making what I'd call innovative or sound strategic decisions about how to respond for futures, not just what's going on this week, this month, this year.
Right.
That's my two
Yeah.
worries.
Yeah. Pause for a second and just say we're going to launch the second poll before we reach our time. So Silva, if you could launch that now, thank you. Yeah. Yeah, Paul. I mean, I think one thing is that I'm sure there is a rhyme or reason to the amounts that come up with this. Like, there's a rhyme or reason why 23 billion was chosen for the market facilitation program and why 12 billion was chosen for the this most recent round, right?
Yep.
But it's not obvious to me, and I don't think it's obvious to farmers probably what to expect in general, right? And I think one thing you're hinting at, and I think economists, to use some economist speak, is that prices are allocative mechanisms, right? They tell producers, they tell consumers, right, that they should purchase more or purchase less of something, right? According to scarcity rents, right? Like that's there's a
Yeah.
lot of theory behind that, but like you said, if we're giving these distortions to the markets and distortions that are not always clear, like if we're offering payments to soybean producers this year because of the trade damages, should they expect those payments again next year? And does that keep people planting soybeans when the market prices really should be indicating that actually they should be making better decisions and planting more corn or wheat or
Whatever. Right.
something else, or like you said, Paul, innovating or taking more approaches, right? And so yeah, it's unclear signals and it's not certain signals either, right, about what will be there available in the future.
Well,
Now,
and I
yeah, go
want to play
ahead.
the conspiracy theorist a little bit. I'm curious about how many, we've been seeing input prices. You worry about fertilizer prices, seed prices, machinery costs. With this $12 billion, are we going to see an uptick in fertilizer prices now and an uptick in seed costs? Because the companies all know farmers are going to have some cash coming. They will be able to afford to buy my fertilizer or my seed, my machinery. Will there be a small uptick? I doubt we could find it in the data. It'll be buried in all the stuff, but it's got to be. I think these really aren't necessarily support for farmers. They are also support for the whole ag industry as a whole. It keeps all the input purchasings going and all the companies that
Yeah,
are buying the grain going. All that stuff. It just keeps it flowing. And so I'm curious how much of that 12 billion ends up distributed out the supply chain, the inputs and the outputs.
the farmers. Yeah. Now, Leonard, back to your original question. I haven't forgot about that. But you talked about sort of integrating things like conservation in with other programs. Is that generally, am I getting that right? Yeah, I mean, I think this was somewhat the notion behind the conservation stewardship program originally. Granted, I was not actually in the industry expert 10 years ago whenever it was originally made, but I think there was this belief that if you continue doing what you're supposed to on the land, then you would continue receiving those payments, and it's not necessarily attached directly to one individual practice or one verification of a single practice that has a bunch of red tape and things attached with it, right? So, but I think we have also seen this with maybe at a more state level, and there was somewhat from the national level as well, but coupling cover crop payments with crop insurance. We have here in Wisconsin, we have a $5 rebate for cover crops, $5 rebate for your insurance if you plant cover crops. EQIP is offering like $65 per acre. So that's, $5 relative to $65 is only a drop in the bucket, but it's still something, right? It's an incentive. But like you said, Leonard, maybe there's a way to reach more farmers if you put requirements on um, crop insurance premiums in general, right? Like if you're going to receive a uh, if you want to receive a subsidy for your crop insurance premium, then you have to, abide by a certain set of practices, right? And um, I think we have seen that on a small scale, things like nutrient management plans here in Wisconsin, if you want to receive farmland preservation payments and so on. So I think there is a way, right, where we can couple some of those things together. And it's somewhat of a mix of, to be honest, it's a mix of carrots and sticks, right? And there's some regulatory lever behind it, but that is a way that's not necessarily reliant on that cap, um, independent on what that cap is in any given cycle.
So the next question then is, with this uncertainty that's happening in the ad hoc payments, um, what is the group's experience? What are you hearing out there from folks just kind of waving a hand at risk management things, or at, like Dr. Mitchell said, some of these hard decisions, and saying, "Wow, we'll likely get a payment, right? So it'll be all right because we'll likely get a payment." Um, Thoughts on that?
Yeah, I mean, I would say that um, this should not be an expectation for farmers moving forward. Or I hope that that's not the case for our industry, is that there will always be this ad hoc kind of nature of payments. And I would hope that, farmers they, like you said, take this payment that's available, but as we know, that policymaking is not always a given, and if you expect to be compensated in low margin years like we've experienced the last few years, that may end up resulting in some pretty hard realities, right? Um, so yeah, I don't know, Paul, you have any take on that?
Yeah, I do worry about the sustainability of these ad hoc payments. But I mean, the right now and the crop side, it's all about cash flow is a big issue, and these payments will help. And so it's easy to solve risk management problems when you've got cash coming in. You can cash flow through it. Um, and like I said, I worry about. I remember when crop insurance was really pushed back it started really pushing hard in the 90s and the 2000s, when they wanted to get away from ad hoc payments for disasters. They wanted something more dependable from the government side, that they could budget and understand how it worked. And here we are, 30 years later, 20 years later, and we're perfectly happy with these random events, and throwing money at the problem, and not as worried about a consistent, dependable a budget clear process to plan ahead. So politics, I feel like a lot of this is a political problem, not a farm problem, and we have to, as an agricultural industry, we have to figure out how to deal with the political problem of these cash flow issues, or these cash problems, um, and how the government's throwing money at them ad hoc. And like I said, I worry it's creating a system that's not healthy for us as an agricultural industry, long term. Um,
Uh, the other thing that I was just remembered is that there's actually some pretty high caliber economic research that when government payments are made, they accrue to the landowner over the long run,
yes.
right? So there's this reality that we potentially are inflating, at least to some extent, land prices, and that increases the asset value of land, but it makes it harder for um, folks to enter the business in general, but also for folks who are rental, um, who rent a lot of their land, right? Um, Tend to be the hurt by that type of policy, right? So
Yeah, this is like Leonard was talking. I think it helps contribute to consolidation, broadly
yeah,
defined, in terms of it's just harder and harder to break in. And so the ones that exist are the ones who can afford to buy the other people's land when for some reason it becomes available. And the new people can't get in. Or it's hard to get in anyway.
All right, well, we are at 1 o'clock. So we'll go ahead and wrap up there. But I do want to thank everyone again for joining for these 4 weeks for this conversation. Like I said, it's been informative for me. I hope it's been informative for everyone else to get to learn more from our experts here within UW Extension. Um, I think we'll kind of reconvene and think about this, but look for this type of event in the future. We have the folks who are experts within extension now, and kind of a new group of us between myself, Leonard, Kelly, and Silva. As foreign policy uncertainty continues to continue to unravel in the next year, we'll have a lot to talk about in the new year as well. So thanks again for everyone for joining us, and feel free to follow up with any of us afterwards if you have questions about any of our specific presentations. Take care all. Happy holidays.